Hello everyone. Today we will talk about an investor who put 10.5 Indian rupees lakh across 7 mutual funds and simply stayed invested through every crash, is sitting on 6.51 Indian rupees crore today. No stock tips, no timing the market, no shortcuts, just patience, discipline, and one powerful strategy: buy when others fear, hold when others run. Let's take a closer look at the power of staying invested over the long term. This slide highlights a case study based on the 7 oldest active mutual funds, analyzing between 20 to 31 years of real market data. What stands out immediately is that despite experiencing 5 different market crashes during this period, the portfolio grew remarkably. Starting with a total investment of just over 10.5 lakh rupees, the portfolio value surged to an impressive 6.51 crore rupees. That's a return multiple of 62 times the original investment. This clearly demonstrates how staying committed through market ups and downs can lead to significant wealth creation. It's a powerful reminder that consistency and patience in equity mutual funds can truly pay off over the long haul. Let's start by addressing some common myths that many investors believe and compare them with what the actual data shows. First, the myth that you should wait for a market crash before investing. The reality is quite the opposite. Take Mr. Wise Investor, who invested his 1 Indian rupee lakh right at the inception. Over time, his investment grew by 100 to 200 times. Waiting for the perfect moment means missing out on years of valuable compounding growth. Next, there's the belief that you should sell everything when the market crashes. The truth is, the 5 major market crashes actually presented the best buying opportunities. Those who purchased during these periods of fear ended up with more units and ultimately maximum returns. Another common misconception is that fixed deposits, or FDs, are safer than mutual funds. While FDs might seem safe on the surface, the numbers tell a different story. For example, 1 Indian rupee lakh invested in an FD at 6% for 30 years grows to about 5.74 Indian rupees lakh. But the same amount invested in a fund like HDFC Flexi Cap can grow to over 2 Indian rupees crore. So ironically, the seemingly safe FD is actually the riskiest choice when it comes to long-term growth. Finally, many think they need to perfectly time the market to succeed. However, none of the 7 funds analyzed required perfect timing. Simply investing at inception and holding on to the investment outperformed almost every active trading strategy. As Warren Buffett wisely said, the stock market is a device for transferring money from the impatient to the patient. Patience and disciplined investing really do pay off in the long run. Here, we're looking at the 7 funds that have been the most reliable wealth creators in India over the long term. These are some of the oldest active equity funds, each with an uninterrupted performance history spanning 20 to 31 years. Starting with the ICICI Prudential Large and Mid Cap Fund, established in 1994, an initial investment of 1 lakh rupees would have grown to over 1.04 crore rupees, with a compound annual growth rate, or CAGR, of 18.3% and assets under management of nearly 28,500 crore rupees. Next, the Myri Asset Large and Mid-Cap Fund, started in 2010. Despite being newer, it shows impressive growth. A 1 lakh investment turning into 16.7 lakhs, with a CAGR of 19.6% and assets of over 42,900 crore rupees. The Canara Robeco Large and Mid-Cap Fund, from 2005, would have grown the same initial amount to 27 lakhs, delivering a 17% CAGR with almost 24,735 crore in assets. Then there's the AB Sun Life Flexi Cap Fund, established in 1998, which would have turned that investment into 1.83 crore rupees, boasting a solid 20.8% CAGR and assets just over 25,000 crore. The HDFC Flexi Cap Fund, going back to 1995, shows an increase to 2.04 crore rupees with a CAGR of 18.6%, managing the largest asset pool here at over 1 lakh crore rupees. Nippon India Multi-Cap, from 2005, would have grown the initial investment to 31.2 lakhs, with a 17.8% CAGR and assets close to 48,800 crore. Lastly, the ICICI Prudential Multi-Cap Fund, also starting in 1994, shows growth to 83.8 lakhs with a 15.1% CAGR and assets around 16,300 crore rupees. An important note is the investment strategy. Starting with 1 lakh rupees per fund at inception, plus an additional 10,000 rupees during each of 5 market crashes, totaling an invested amount of 10.5 lakh rupees across these funds. This steady approach through market cycles has compounded substantial wealth over time. Here we see a powerful lesson from market history, showing 5 major crashes and how a wise investor turned fear into opportunity. During the 9/11 and dot-com bust in late 2001, the market dropped by about 50%. Instead of panicking, the investor added 10,000 rupees per fund, seizing the chance to buy at lower prices. Then came the global financial crisis from late 2008 to early 2009, with the market falling roughly 60%. Again, the same action was taken, investing more during the downturn. Fast forward to the COVID-19 crash between February and May 2020, where the market declined around 38%, and yet, once again, additional investments were made. The same strategy was followed during the 2025 correction with an 18% drop and the 2026 correction with a 10% decrease. In total, investing consistently during these 5 downturns amounted to 350,000 rupees added strategically. This disciplined approach didn't just protect capital, it created wealth in the millions. This perfectly echoes Warren Buffett's famous advice: be greedy when others are fearful. It's about recognizing that downturns are often the best times to invest wisely and build long-term wealth. Here, we're comparing 2 strategies, just holding your investments versus holding and also buying additional units when the market dips. Both strategies use the same initial funds, but the results are strikingly different. Take the HDFC Flexi Cap, for example. If you just held, your investment grew to 1.89 crore rupees. But if you bought on dips as well, that figure jumps to 2.04 crore rupees, adding an extra 14.6 lakh rupees from those top-up purchases alone. Similarly, for AB Flexi Cap, holding got you 1.71 crore, but adding dip buys increased it to 1.83 crore, giving an extra 11.3 lakh. The ICICI Prudential Large and Mid Cap Fund saw a boost from 95.6 lakh to 1.04 crore, adding 8.4 lakh extra. And for ICICI Prudential Multi-Cap, the difference is from 74.1 lakh to 83.8 lakh, which means an extra 9.6 lakh. In total, by investing just 3.5 lakh more during those dips, the extra wealth generated is over 50 lakh rupees. That's an average return of more than 14 times on those additional dip investments. This really highlights the power of buying during market downturns to significantly enhance your overall returns. Let's dive into some powerful insights from 30 years of data across 7 different funds. First, the power of compounding is truly remarkable. For example, just 1 lakh rupees invested in HDFC Flexi Cap back in 1995 has grown to a staggering 2.04 crore today. That's a 204 times return over 31 years, with money doubling approximately every 4 years at an 18.6% annual growth rate. Next, market crashes should not be feared. They're actually prime buying opportunities. Take the 2009 financial crisis. Units bought then, like those in Canara Robeco at a net asset value of just 6.80 rupees, are now worth 33 times more. The lowest NAV purchases during downturns often lead to the highest returns. Another key point is that time in the market beats trying to time the market. Even investors who started right before big crashes, such as the dot-com crash in 2001 with ICICI Prudential Multi-Cap, still achieved strong returns, clocking in at 15.1% CAGR despite tough starts. When we look at performance versus benchmarks, all 7 funds outperformed the Nifty 50 index, delivering between 3 to 7% alpha annually. For instance, AB Sun Life Flexi Cap returned 20.8% annually compared to Nifty's 13.5%, creating a significant advantage over 28 years. A cumulative return of 183 times versus about 35 times for the Nifty. Combining a systematic investment plan, or SIP, with opportunistic investments during market crashes leads to maximum wealth creation. Those extra investments at low NAV points generated substantial additional returns, turning every 10,000 rupees invested during crashes into an extra 1 to 3 lakh rupees over time, thanks to longer compounding periods. Finally, looking at the overall portfolio, a total investment of 10.5 lakh rupees spread across these 7 funds, including lump sums and crash investments, grew into 6.51 crore rupees. That's a 62 times increase. The takeaway here is clear: no complex schemes, just the discipline of staying invested patiently through every market storm and sunrise. As the saying goes, wealth is not built in a day. It's built by staying invested consistently over the long haul. Behavioral finance shows us that the biggest challenge investors face isn't the market itself, it's their own emotions. Let's look at the differences between an emotional investor and a wise investor. An emotional investor tends to panic and sell during a market crash, whereas a wise investor stays calm and sees the crash as an opportunity to buy at a discount. Emotional investors often wait for the right time to invest, which often means they never actually get started. On the other hand, wise investors start immediately, maximizing the power of compounding over time. When the market falls by 20%, emotional investors stop their SIPs, systematic investment plans, while wise investors actually double down and increase their SIPs. During uncertain times, emotional investors might move their money to safer options like fixed deposits or gold, but wise investors continue investing in equities despite volatility. Emotional investors get swayed by sensational news and expert opinions on TV, whereas wise investors focus on the quality of their funds and keep their long-term goals in mind. If they don't see quick returns, emotional investors often exit after just 2 or 3 years. Wise investors commit for the long haul, staying invested for 10 to 20 years or more. According to the Dalbar study, the average Indian equity investor earns only about 5 to 6% annually, largely due to panic selling, while those who stay invested can achieve market returns in the 15 to 20% range. The difference? It's all about investor behavior. Let's wrap up with the key takeaway. Time in the market always beats timing the market. For existing investors, the advice is clear: stay invested. Don't let panic force you to sell and lose out on the power of compounding that's working in your favor right now. For those new to investing, start today. Every month you delay means missing out on potential growth. So begin your monthly SP, even if it's just a small amount like 1,000 Indian rupees. And to the fence sitters who are waiting for the perfect moment, remember, that time was 20 years ago. The second best time to invest is right now. There's no crystal clear perfect timing, so don't hesitate. This approach is backed by fund NAV data up to March 16, 2026, but always keep in mind that past performance doesn't guarantee future results. It's wise to consult your financial advisor before making big decisions.